This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stocks slide. Concerns mount that the global economy is slowing, and the major indexes have one of their worst days of the year.
Spring has sprung in housing. Sales register one of their largest monthly gains ever. And there's one thing that's driving demand.
Digital divide. Retailers in some cities want to ban cash, but lawmakers say it's still king. Those stories and more tonight on Nightly Business Report for Friday, March 22nd.
And we do bid you a good evening, everybody, and welcome. Wall Street connected some economic dots today, and the result was an ugly end to the week. Stocks fell hard because of weak data both here and abroad, with one report suggesting that Germany may be in recession. And for the first time in years, the 3-month T-bill is now yielding more than the 10-year note. That is the definition of an inverted yield curve, which sometimes foreshadows a recession. At the close, the Dow Industrial Average was down by 460 points, closed at 25,502. The NASDAQ was down 196. The S&P fell by 54, and for the week, all of them were down a fraction at least. Bob Pisani starts us off tonight from the New York Stock Exchange.
What happened to our rally? Yesterday at the high point, the S&P 500 was just about 2% away from its record high. But global growth fears have swooped right back in. Now remember the bull narrative. The Federal Reserve and the central banks around the world, they've got our backs. The tariffs are going to go away. The Chinese are going to stimulate their way out of the slowdown. And the Europeans, the data is not going to get any worse. Well, here's what actually is going on. We do have a much more patient Fed and central banks around the world, but that's now priced in. The president has made it clear there may be no immediate reduction in tariffs. That's a problem. And overnight, we got dismal European manufacturing data, particularly in Germany, where the yield on the 10-year over there went to zero. Here in the U.S., we're continuing to see our own bond yields move to the downside. Now, keep in mind, most big companies in the S&P 500 get about 40% of their revenues from businesses overseas, and that's why this global growth equation is such a big deal. So if this weak global economic growth narrative stays with us, at this level, it means stocks are very pricey. Then couple that with lower interest rates. That's taking a toll on the banks. The regional banks this week, like SunTrust and Zions, they're getting clobbered. They're all down 9 or 10%. Meanwhile, we've seen a number of these defensive interest rate sensitive sectors hit new highs. So real estate investment trusts, historic high today. Utilities, historic high today. They tend to do well when rates are low. Defensive names like Verizon and Pepsi, Coke, they were doing well today. But the more volatile names, particularly tech names, so AMD and Micron or Netflix, Nvidia, they're on the downside. So the bottom line is this. The bull narrative is sort of running up against economic reality. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So if the global economy is slowing and interest rates are on hold, you're probably on the hunt for yield, looking for the best places that will give you a little bit of income. Dave Nottig joins us. He's managing director of ETF.com. He's here with some ideas. Good to see you, Dave. Welcome.
Thanks for having me.
You say the way that investors should think about this is yield versus risk. And so we divided your different picks into low risk to high risk. So let's start with the first one, which would be low risk. That's the Vanguard S&P 500, VOO. Why do you like that?
Yeah, so I think a lot of people look to traditional dividend-paying stocks as a kind of safe haven when you've got a low interest rate environment like this. The S&P 500 pays about a 2% dividend right now. So for every $1,000 you invest, you're getting about $20 a year back in dividends. That's been a consistent source of return for a lot of investors for many years. It's a good thing to think about when you're looking at such low interest rates, particularly in the long bond.
In our moderate risk category here, you've got the Global X Super Dividend US ETF, DIV. You're going to get a better yield, but you're going to pay for it as well, right?
Yeah, so where something like VOO, that S&P fund, might charge 4 basis points or 0.04% a year, DIV is more, I think, in the 48 basis point range. In other words, about 0.5% a year. You're also getting a much more risky portfolio. It's holding small cap stocks, it's holding mid cap stocks, and it's only holding 40 or 50 stocks at a time. So it's a more concentrated portfolio. But what you get? A yield of about 7%. That's a huge uptick from just the regular old S&P 500.
And if you want to be even more aggressive and you can sleep at night, you also picked for the higher risk the iShares Mortgage Real Estate, REM. And that includes like limited partnerships, REITs, malls, things like that.
Yeah, so real estate has always been a place people go to get consistent income, right? It's a time-honored tradition. You're going to get yields of close to 10% there, but again, you're investing in a very narrow corner of the market. Similarly, master limited partnerships, which tend to own things like natural gas pipelines, they yield about 10% too. But again, you're taking much more risk, and you're going to be paying more in that 0.5% range for fees.
What's the yield on that, right quick?
Right about 10%.
Yeah.
There you go. Dave, thanks so much. Dave Nottig with ETF.com.
Late today, an item in the news that Wall Street will be watching very carefully. Justice Department Special Counsel Robert Mueller closed his Russia investigation into possible interference in the 2016 election and related matters. The report is now with Attorney General William Barr, who, according to Dow Jones, said that he may send Congress a summary of those findings by this weekend. The White House says the president has not been briefed on the document. The investigation took 2 years. It resulted in felony charges against 34 people, including 6 who served on Mr. Trump's campaign.
To the economy now and the housing market. Sales of existing homes recorded one of their largest monthly gains ever in February. Diana Olick explains what was behind that jump and whether it can continue.
Home buyers came back in force in February, responding to a sharp drop in mortgage interest rates. Sales of existing homes jumped nearly 12% compared with January, but were still about 2% lower annually.
As the mortgage rate began to drop, there was evidently a strong pent-up demand. People wanted to take a second chance opportunity, and also more choices, more inventory choices, prices moderating, still good economic fundamentals of job creation.
The average rate on the 30-year fix started last year pretty low, boosting sales. But as that rate rose, sales weakened. And by November, when it went over 5%, sales collapsed. Then rates began falling again, and buyers reacted. The supply of homes for sale has also been rising for several months, although builders are still not putting up enough entry-level homes. And then there are those overheated home prices, still up over 3% in February, but the gains have been shrinking, and sellers are slowly coming down to earth as their homes sit on the market longer. The question now is, can this higher sales pace hold on?
It is sustainable provided that home price growth moderates, and that is dependent upon increased supply. So builders need to get active in building moderately priced homes because there is a sufficient demand for moderately priced homes.
If supply does not increase, however, home prices could start heating up again, and even today's lower mortgage rates would not be enough to counter those gains. For Nightly Business Report, I'm Diana Olick in Washington.
The U.S. posted its biggest monthly budget deficit on record last month. This as tax revenue fell and federal spending for things like agriculture and transportation programs increased. The budget gap widened to $234 billion in February, pushing the deficit for the first 5 months of the government's fiscal year up almost 40% from a year ago.
One day after the Treasury Department imposed new sanctions on North Korea, President Trump reversed them. The White House press secretary said today the decision explained the decision by saying the president likes Chairman Kim Jong-un and does not think the sanctions are necessary. Yesterday, Treasury targeted 2 Chinese shipping companies accused of helping Pyongyang evade existing economic sanctions. This latest policy directive comes about 1 month after the second summit between the United States and North Korea.
Taxpayers may be getting some relief. The Treasury Department today said that it would waive some penalties for those who did not have enough taxes withheld from their paychecks last year. It will apply to those who paid at least 80% of their liability during the year. As we reported, many were surprised by their tax bills because they failed to adjust that withholding amount.
And President Trump said today that he plans to nominate economist Stephen Moore to fill one of the 2 vacancies on the Federal Reserve's board. Moore is currently a visiting fellow at the Heritage Foundation. He also served as an economic advisor to Mr. Trump during the 2016 presidential campaign. He is a defender of tax cuts and has been critical of policy moves made by Fed Chair Jerome Powell, just as the president has.
Time to take a look at some of today's upgrades and downgrades. Best Buy was upgraded to outperform from perform at Oppenheimer. The analyst cites improved sales and earnings power. The price target is $86. Despite the upgrade, the stock fell a fraction to $70.11. Chipotle was upgraded to neutral from underperform at Wedbush Securities. The analyst cites channel checks that suggest a more than 6% increase in same-store sales in the first quarter. The price target is $640, which is below today's closing price of $671.46.
Lululemon was downgraded to neutral from outperform, also at Wedbush Securities. The analyst cited a tougher economic environment for retail and the potential for lower margins as a result. Price target now $155. That stock fell more than 3.5% today to $143.21. And Biogen was downgraded by a number of firms today, including Morgan Stanley, which lowered its rating on the stock to underweight from overweight. The analyst cited that failure of those 2 Alzheimer's drug trials that we told you about yesterday. Price target now $210. That stock fell more than 4.5% today to $216.71.
Still ahead, GM's new roadmap.
GM is boosting production in North America, adding 700 new jobs. I'm Phil LeBeau in Lake Orion, Michigan. We'll have the numbers and why GM is building more in the U.S. That story coming up on Nightly Business Report.
Pinterest has filed to go public. The company released its IPO prospectus, which shows the tech company generated more than $750 million in revenue last year, losing about $63 million. It had roughly 265 million monthly active users, and it plans to trade on the New York Stock Exchange under the ticker symbol PINS.
Indonesia's national airline says it wants to cancel its order for Boeing's 737 MAX jet. It had ordered 49 planes, of which just 1 had been delivered. The total order was worth nearly $5 billion. The airline says that it's difficult to cancel agreements once they have been signed, but that it will continue to talk with Boeing.
General Motors is planning to hire hundreds of workers and expand production. This after the automaker idled plants in the U.S. and became a target of President Trump for doing so. Phil LeBeau reports tonight from Lake Orion, Michigan.
Our chairman and CEO, Mary Barra.
GM CEO Mary Barra calls it a major investment, and it is. GM will spend $1.8 billion, hire 700 workers, and build a new electric car here in the U.S.
It's going to come out in a year or two. We haven't released the specific date yet, and there'll be a lot more to follow on the specifics of the product. But today we're really focused on the workforce at Lake Orion.
Unfortunately for Barra, President Trump continues to focus on GM's decision to end production at its plant in Lordstown, Ohio. While many, but not all of those workers have transferred to jobs at other GM facilities, the Lordstown plant remains idled, and that's what bothers the president. Recently tweeting, just spoke to Mary Barra, CEO of General Motors, about the Lordstown, Ohio plant. I am not happy that it is closed when everything else in our country is booming. I asked her to sell it or do something quickly. She blamed the UAW union. I don't care. I just want it open.
You're all focused on that relationship. I mean, he has an agenda. It's about job creation. I think I very much want the company to continue to grow, to continue to invest in the United States. We are committed.
Ultimately, GM wants more efficient plants, something it's struggled to do compared to Ford and Fiat Chrysler. That means GM having fewer plants, being more productive, but more profitable. For GM workers at the Lake Orion plant, today's news is welcome.
It's exciting. We had some doom and gloom there for a while. We didn't know what was happening with our plant.
I think it's a blessing. You know, I thank God that we have it. It's been looking pretty gloom for the automotive companies, so we need this big time.
With the UAW contract expiring this fall, GM's decision to end production in Lordstown, Ohio, and at other plants in the U.S. is likely to be a point of contention in those negotiations. And that's separate from any tweets the president may send out pushing GM to reopen plants. Phil LeBeau, Nightly Business Report, Lake Orion, Michigan.
Tiffany CEO says the future looks bright. And that's where we begin tonight's Market Focus. The luxury jeweler expects growth to resume in the second half of this year, helped by a rebound in its e-commerce business. And that forecast helped offset slightly disappointing quarterly sales. The company also stuck to its 2019 revenue and profit targets. Stocks were up 3% at the close. They had been down about 5.5% at one time, but they finished the day at 103.21. Elsewhere, sporting goods retailer Hibbett Sports easily surpassed Wall Street earnings estimates and issued an upbeat outlook. Same-store sales were also better than expected. The company cited its e-commerce strategy and plans to close about 95 brick-and-mortar stores. The stock soared by 20% today to $21.70.
Nokia warns of possible compliance issues. The network equipment maker revealed it is investigating transactions at Alcatel-Lucent, which Nokia acquired in 2016. Nokia says investigators have been made aware, and it's conducting an internal investigation. The shares fell 6% to $5.88. Former basketball star Shaquille O'Neal is joining Papa John's board of directors. O'Neal is also its brand ambassador and an investor in 9 of its restaurants in Atlanta.
It's a great opportunity. We want to create a culture there now where people are loved, welcome, and accepted. We don't want to have any problems. And listen, peace is fun. Everyone knows Shaquille O'Neal. They know that I'm in the fun business, and we want to get this thing back on track.
The appointment comes as the pizza chain attempts to fix its image after its founder reportedly used a racial slur on a media training call last year. The stock price was up 6% to $49.80.
This week's Market Monitor likes stocks that he says will benefit from a slowing economy. Now, last time he was with us was a year ago in April of 2018. At that time, he liked Amazon, which is up 22% since then. He liked KeyCorp, which is down 24%, and Microsoft, which is up 25% since then. John Trainer's back with us. He's Chief Investment Officer with People's United Advisors. John, good to see you again. Welcome back.
Good to see you. Thank you.
And you still like Microsoft. How does that benefit from a slowing economy?
Well, we had what I believe to be a good appreciation for where the economy was last year. We never bought into the permanent 4%, 3% growth. We thought we'd be slowing. So we erred on the side of owning good companies like Microsoft that can really take control of their earnings. They don't need a strong economy to grow. And that's the bias we had last year, and we're actually very happy with that bias in portfolios right now. Owning good companies that are growing their earnings because of good core organic growth.
And your second pick is Johnson & Johnson. It is a strong growth stock, you say, but it doesn't necessarily need a strong economy to continue to succeed, because there are people who are talking about our economy slowing.
Exactly, and I was very pleased to see, even though Johnson & Johnson was down today, it was down fractionally, it actually held up fairly well. One of the things you want to look for in a market like this are what are the stocks that really are not going down, that tends to give you a sense of where things are going. We think investors will really appreciate that good, strong Johnson & Johnson cash flow, and they'll be rewarded owning that stock going forward.
And finally, Home Depot. Clearly, they've done well as the housing market continues to bump along here. Is this necessarily a bet on a better housing market?
Well, it's a bet on the fact that we didn't think interest rates were going to go through the roof. So you saw rates come down today. That should be good for mortgage rates. And Home Depot, you saw the good housing numbers today. Home Depot is a beneficiary of new housing starts, but then also individuals that are staying in their home and the home repair. So we see them at the crossroads of two very good trends that we see going forward for a while.
All right, we will see what happens. John, again, thanks for joining us. John Trainer with People's United Advisors.
When CEO Dan Schulman spun off PayPal from eBay 4 years ago, he made diversity, inclusion, and equal pay a priority. But as Julia Borston reports, his HR team couldn't tell him if they were paying fairly across gender and race.
I said right away to that, that's ridiculous. I mean, we should know right away if we're paying equally or not, and I want an outside study to go and look at this, and we want to address this gap if there is one immediately.
That first year, the company found and fixed a $3 million pay gap. Since then, PayPal has reviewed its 20,000 employees' pay and performance 3 times a year, with audits by 2 outside companies. Here's how it works. HR sets a pay range for each job category and location, looking at demand for certain skills as well as experience. Then, managers evaluate employees' performance across 12 categories, including communication and collaboration, and whether they've hit specific targets.
I am being as fair as possible and as equitable as possible by using these very objective frameworks.
But bias still creeps in, so HR works with consultants to compare pay across the whole company to ensure there's no gender or racial discrimination.
So we don't leave it to chance. And we don't leave it to individual managers to pick their favorite people.
3 years after fixing that original $3 million pay gap, the company found and fixed a pay gap just a tenth that size, roughly $300,000. Fixing the pay gap was the first step. Now comes the harder part of closing the gender gap in top-paid management and engineering roles.
Equal pay seemed like the easiest actually thing to address right away, because if you look at like what percent of women were in leadership roles or ethnic minorities were in leadership roles, that takes longer to address.
Now the company is focused on hiring and promoting more women and minorities into those jobs.
You can spend all this time hiring people, but if you don't have processes and thoughts about how welcome somebody feels when they come to a company, they churn out.
PayPal trains employees to be aware of unconscious bias. For positions at the director level and above, last year the company introduced a policy to interview at least one diverse candidate. Schulman says these policies aren't just better for employees, they're also better for shareholders.
Companies that are more diverse perform better. And I thought if we were going to be successful and build a great enduring company, we had to have diversity.
Schulman says the advantages of this focus on diversity are not just bringing in a range of perspectives, but also the ability to attract top talent. For Nightly Business Report, I'm Julia Borston.
And coming up, why cold hard cash may never go out of style, even in our digital world. Here's what we're watching for next week. This is highly anticipated on Monday. Apple expected to unveil that new streaming video service and a paid subscription news service. Then on Wednesday, a Senate panel holds a hearing on airline safety following the deadly crashes of those 2 Boeing 737 MAX aircrafts. And on Thursday, the final read on economic growth for the 4th quarter is due, and that's what we're watching for next week.
And ahead of that Apple Monday announcement, the Wall Street Journal has reportedly agreed to join Apple's new paid subscription news service. But other publishers have opted out joining, including the New York Times and the Washington Post. The New York Times CEO told Reuters last night that relying on third-party distribution can be dangerous for publishers who risk losing control of their own product.
Retailers are also going digital, with some merchants preferring to accept mobile payments only, no cash. But lawmakers are saying not so fast. Frank Holland is in Philadelphia tonight with a look at the digital divide.
Philadelphia, the birthplace of the American Revolution, appears to be starting a new revolution against a cashless economy.
There's a certain group of people, just for example, in Philadelphia, that when these few businesses that had gone cashless, they couldn't go in there. And that's not correct.
Councilman Bill Greenlee pushed for the law that will force most stores to continue taking cash. Businesses that have gone cashless say it speeds up transactions and makes bookkeeping more efficient. But Greenlee says it discriminates against consumers who are unbanked, meaning they don't have checking or savings accounts. About 6.5% of households in the U.S. are unbanked, according to the FDIC. Philadelphia's not alone. New Jersey passed a cashless ban this week, and New York City and Washington, D.C. are considering similar laws. Even in the heart of Silicon Valley, San Francisco lawmakers are proposing an even stricter cashless ban that would include Amazon Go stores. Here at Philadelphia's Reading Terminal Market, consumers and merchants have strong feelings about this new law.
I feel like the cashless stores are exclusionary, and Philadelphia has a pretty high poverty rate. So I think it's good for Philadelphia in particular, so that everybody has an option to shop where they want.
That's a business decision. As more and more regulations are put on the small business owner, it's harder and harder to operate in the city.
If they don't like running business in Philadelphia, move somewhere else.
Councilman Greenlee says he doesn't believe this law will hurt existing businesses or discourage new companies from coming to Philly.
I really don't want to make it sound like it's an anti-business thing. I don't think it is. I would say it's just a pro-person, pro-consumer.
30% of all transactions in the U.S. are made with cash, 27% with debit cards, and 21% with credit cards. While a digital future may be inevitable, cash is still king. For Nightly Business Report, I'm Frank Holland in Philadelphia.
And before we go, here's a look at the final numbers from Wall Street on this Friday. It was a negative day. The Dow dropped 460 points. The Nasdaq was down 196, and the S&P 500 fell 54. And that pushed the stock market lower for the week as a whole. That'll do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. See you on Monday.